Welcome to the Physician Wealth Med podcast. It's wealth medicine for doctors. If you're a doctor and you have no time, it looks like you found us just in time. This podcast is for all doctors who would like to work on their personal wealth, but do not have traditional hours to do so because they have no time. We're here to jump into topics that will help you address your wealth both inside and outside of your practice so that you can live the life of significance you're dreaming of. You'll hear from your peers, you'll hear from industry professionals, and your host and wealth advisor, me, Kevin Sullivan. This is your time. Now let's get started with today's podcast. Welcome to Physician Wealth Med Podcast. We're so excited today to bring you some great content with Lloyd Ippolito CPA. This is my second podcast with Lloyd, and we're so thankful that he's taken some time out of his schedule to join us for this podcast today. Lloyd, I had three titles for this: Wealth Beyond the Tax Return, or Wealth Integrated with the Tax Return, or Wealth Because of the Tax Return. So I don't know which one you want to look at here, but I like them all. We'll have to figure it out.
I like them all. I like them all too. I think I'm a little bit more partial to the last one, Wealth Because of the Tax Return.
There you have it.
And being able to use a tax return is something that people kind of view as a necessary evil. The requirement to file tax returns, pay taxes, and use that as a tool to build wealth.
Excellent. Well, let me tell you about that. I might just use that one, Wealth Because of the Tax Return. That's excellent. I was thinking when I was coming through this, there's accountants, there's tax preparers, there's CPAs, and some CPAs are reactive. As you know, you've been in the industry for a long time. They'll give you a tax return based on what's happened in the past. But then there's proactive CPAs. And then there are proactive, knowledgeable tax planning CPAs, and crescendo. That's where you come in. That's Lloyd Ippolito right there. One of the things that impresses me so much about how you stick with your clients throughout the entire year and you do that forward-looking tax planning. We'll get into that in just a little bit. But that's why I like having you on the podcast. That's why I like working with you personally, because of that attention that you give on that proactive basis. And please don't ever underestimate. If you're listening to us today, if you're watching us today, please do not underestimate the power of proactivity when it comes to your taxes. I often talk to doctors and I tell doctors, I say, look, if you're a doctor and you can fix a problem, people will come to you no matter where you live. You might live in Texas, but if you're the right doctor to fix the problem, people are going to come see you. They're going to cross state lines. They'll fly to Texas, and because if you're the one, you're the one. And there's no difference with your financial professionals. And this is the most important message that we can bring to the table today. As a doctor, if you know you have the right CPA or the right wealth advisor or the right attorney, and you know that they're the right fit to fix your problems, you should do the same things too. You should cross state lines. You should have a video meeting and take that time to seek out the right professionals who will help you where you want to be and need to go. You may not even know what you need or who you need at this particular time, but when you're working with the right CPA, when you're working with the right wealth advisor, and when you're working with the right attorney, you will know and it will become crystal clear. There's nothing like a proactive financial team of professionals who have your best interest in mind and hold themselves accountable every day to make sure that they know what you need and to see your goals through and to partner with you, taking a vested interest in your success. So that's my compelling case for working with the right people at the right place at the right time. And it may not be who you think it is on Main Street, USA, in your town or your city. This is why we go through such great lengths to get quality people here and professionals to talk to you about your wealth building. And that's why I have Lloyd Ippolito here with me today. So let's just jump right into some of these questions. I sent Lloyd some questions ahead of time so that we would have a little track of what we're talking about. So I wanted to have Lloyd talk about how saving taxes is one of the quickest ways to personal wealth, because you hear that a lot. People say, well, the quickest way to gain money is to save money in taxes. And there's a number of pre-tax things out there that you can do with 401ks and simple IRAs and some of the different plans that are out there that allow you to use some pre-tax savings to get your income down. But I wanted to have Lloyd talk about this particular thought about saving money and taxes is the quickest way to wealth.
Well, Kevin, people often taxes are going to be people's number one largest expense. You might look at how you might do a typical budget and say 30% of your money is going to be spent on housing, but it's going to be very possible that somebody's going to be paying, particularly if they're a business owner, well in excess of 30% of their income in income taxes. And then above and beyond that, figure in all the other taxes that are not income tax based, but they're still hidden within your normal everyday expenses. You and I are both in New York, so surely we're no stranger to property taxes. And then on top of that, we have sales tax, gasoline tax, other excise taxes, FICA taxes on money people are making off W-2, and then a whole litany of other taxes are going to rear their ugly head too. So what comes down to it, it's look at the low-hanging fruit, trying to cut what for many people is going to be and will always be their largest expense possible. So one of the approaches that we take is we look at the tax code, we look at that as a roadmap in order to save money on taxes. So one thing I'd encourage you to link to in your show notes is we're a member of the Wealthability Network, and we work very closely with Tom Wheelwright. And Tom Wheelwright's latest book, maybe about a year ago, came out, is Win-Win Wealth Strategies: the 7 investments the government will pay you to make. And yes, does he talk about some of the benefits of retirement accounts and why the government throws that out as an incentive in the first place? Yes, absolutely. The common theme, though, is that he's identified that these are 7 areas where the government knows that it can't do it better than the private sector can. So by offering these incentives to, in some cases, everyday taxpayers, and in some cases it's going to be limited to business owners and investors, clients can truly use this as a roadmap to reduce their taxes.
Absolutely. I love that book. And one of the things that jump out at me when I read that is the government wants to partner with you. So if they want to partner with you to be able to do these things, they're giving you, like you said, that roadmap. And in order for you to do those things, you can have great tax benefits because of it. And just the way he explains it about partnering with the U.S. government to be able to do that is pretty good. Well, this is good. All right, number 2, in light of tax savings, talk about the doctor that is a W-2 employee versus the doctor that is self-employed in his own practice. What are the differences between saving money and taxes with a W-2 employee versus a business owner, let's say, as far as being a physician or doctor?
Well, I think it kind of goes back to what we were discussing the last time I met with you and we were on this podcast. I said a lot of times when we work with a client, the first thing that we want to start off with is looking at their dream and what their long-term wealth goals are, because that's going to influence not only what tax savings is available to them, it's also going to determine how we, what we even want to do. So, just off the top of my head, let me take, for example, a doctor who has his own practice and is not currently an owner of real estate. Maybe because they're a renter, maybe because their practice is small or it's home-based and they're a type of specialty that they're able to do it, like psychiatry, for example. On the other hand, we have somebody who has an office location, and say they are a general practitioner and they have an office, and it could be anywhere in the country, really. One of the opportunities we have is for them to just simply own that real estate. And real estate has 2 tax advantages, 2 wealth advantages. I wouldn't even say it's tax necessarily, because one of them is just simply the leverage, the ability to borrow funds from the bank and use that to acquire the property. Now, of course, you and I both know that we don't know what's going to happen in the future, but for the most part, real estate has been an asset that's trended upwards over the course of time. So it's fair to say that when the property appreciates, that you're going to continue to receive that growth on the investment, regardless of whether or not there's a loan against it. So when you have that mortgage, you're using the bank's money, but the bank is going to get paid not only with cheaper dollars as a result of inflation, you still pocket that appreciation. So where the tax benefits come in is that we are able to take depreciation deductions off property. Now, some of your listeners, if they're familiar with the concept of depreciation, and particularly if they're physicians, may roll their eyes right now and say, well, it's a shame I can't deduct that against my ordinary income. And for the most part, they're right. But one of the exceptions is if you're generating depreciation. This is why I use the example of this is a building they have their practice in. If that building is used in their practice, that's no different than any other machinery or equipment that they might be buying to run their day-to-day practice. It's an asset used in that trade or business. We are able to deduct that depreciation as part of their active loss, as part of their active income, even though people associate real estate with passive and passive with non-deductible. And for that matter, that's not what passive means.
Right.
Passive means, in the tax sense, it's non-deductible against active income, but it is deductible against passive income. So let's say that we throw this out to a physician. Maybe it's just simply because he already has the building. He doesn't need any more space. He doesn't necessarily want to open up more locations. Well, do we have the opportunity to look at other investments that are going to produce passive income? And that could very well be other real estate investments. It could be other opportunities in which they're a limited partner. Think about a syndicated deal. Think, for example, where they could be investing in the next Google. And there's, there is some ways you have to go about it. It has to be structured as a limited partnership or another pass-through entity. Very rarely would you use an S corp though in that scenario, but it could be.
Right.
And we would want them to have pass-through entity taxation for that to work as an opportunity. And the other thing is, we have the opportunity for a real estate professional. Now, if you have a practicing physician, well, he or she may not be able to be the real estate professional because they're building up their practice, but perhaps they have a spouse that's doing it too. And I'm not going to play the gender card either. I have one client who she is a physician, her husband is a real estate professional. So what happened in that instance, when the husband's out buying all this real estate and she's working in her practice, every dollar of deduction that she's generating from the real estate goes against her income. That allows them to bank a lot more of that income and use that to invest more and more in real estate and not only build their wealth, but they're also using that money to buy the buildings to grow her practice too. So it truly is a symbiosis there, because he's using his skills as a real estate investor, not only to say, well, this is going to be suitable for just for straightforward rental, but also just using to say, well, this is a great opportunity to open up a clinic and otherwise expand her practice.
Absolutely. Man, you just unpacked a lot of things there, even just breaking it down and maybe backing up a little bit too, where I see that a lot, where physicians have their spouses in the real estate, just as you described, and it goes hand in hand really well. The other part is the deductibility as a business owner, because you can deduct all of your expenses from the practice to get you down to your adjusted gross income. And then from there, you're taxed. So if you can add real estate into the mix, you can even go further because of leverage, like you were saying.
Absolutely. In fact, I'll even point to Rich Dad Poor Dad, where Robert Kiyosaki makes the point that when you start with somebody who's a W-2, they will earn the money, they're going to pay taxes, and they're going to spend what's left. Whereas a business owner is going to make their money, they're going to spend the money, and then pay tax on what's left. Now, algebraically, the two are absolutely the same, but the difference is that, if you don't have the withholding on that income, you have free reign to spend that money. Now, of course, you want to put yourself in the position. You don't want to spend Uncle Sam's money and then not be able to pay it to him come next year. But truth is, until that point, you might be working off of an interest-free loan with the government because you could reduce your taxes to the point you never have to hand that money off. So that's really what that piece of the book means.
Right.
So ultimately to your question of, well, what's some of the differences between a physician who's W-2 and one who's not W-2? Well, somebody who's W-2 is not going to have some of those opportunities. Now, a real estate professional, if you have one spouse to be a real estate professional, that's universal. That's pretty much going to work regardless of whether the income is from W-2 or if it's from the practice. That part is relatively straightforward. I don't take credit for this. This is from Tom Wheelwright's book, Tax-Free Wealth. It's if you want to change your tax, you have to change your facts. And sometimes it just starts with a conversation with a prospective client or an existing client and saying to them, right now you're W-2, but it doesn't have to say that way. Locum tenens, I'm sure your physician clients are going to be much more familiar with this than I am, but that sometimes is what they talk about bringing up some contract work. and working on that basis because they'll get paid on a 1099. The 1099 could go into a business entity and allows them to, presumably still work at the same specialty, same area of the country. Of course, there's some travel involved sometimes, from what I understand, but they could still be earning the income and taking advantage of those opportunities of being a business owner. And of course, I want to expand upon that, if you look at the cash flow quadrant, you have 4 quadrants in which people earn their income. You have the employee, self-employed, business owner, and investor. Really, what that doctor did right there is they just created a job for themselves. They just own their job if they're doing that type of work, which is that a bad thing? No, not necessarily.
Right.
If that's something that they want to do and that's something that they're still able to maximize tax benefits for, by all means, that may work for them. But if you're talking about, and I know, Kevin, you're big on this too, if you want to look at this that their practice as a means of a business that they want to exit from at some point, then the truth is you really need to be in that B quadrant and be able to have other people be earning the income for you and you having more of the CEO hat on too. And the tax benefits can differ significantly too. We're going to see that most of those tax benefits are going to be reserved for people in the B and the I quadrants. There are some that are going to be available to everyone. You mentioned one of them being the 401k. And for most clients who may not have ever heard of wealthability or may never want to own their own business, that might very well be the best they could do. There are a handful of others like oil and gas investing. You could do that with a W-2 income. And that's just because the government wants more exploration be done in oil and gas. It's for energy independence. And they incentivize that by allowing people to deduct those losses against ordinary income. Even though in every other respect in the tax code, but for this exception, it would have been a passive loss. Lastly, we have deductions. Being a W-2 employee, if the Tax Cuts and Jobs Act has taught us anything, it's that most of the deductions that are still remaining are remaining for the business owners. And those could be things that are as innocuous as you having to drive from your house to your practice can be a deductible business trip. Not so for a W-2 employee. Same thing if they have space in the office. Again, this is the aftermath of COVID. The clients who were business owners were able to take that deduction. Of course, many of them were doing it anyway before COVID. But the requirement was that they have business use of the home, and the employee use does not rise to that level unless the employer was going to reimburse them. But I have not seen any employer post-COVID or otherwise that was willing to do that for employees.
Yeah. Well, I'm really glad you brought up the 4 quadrants. And what I'm going to try to do is I'll make that PDF available on the 4 quadrants on this podcast too. So you can kind of look at that a little bit longer and then re-listen to how Lloyd explained that so that you'll be able to see what he's talking about there if you don't know about that already. Hey, listen, one of the major reasons why we're doing this podcast is to help physicians with their wealth building outside of their practice. We want you to have wealth building inside of your practice too. And I know that you work on that every day, but we really want to help you focus on some wealth outside of your practice. So that's what's going to last for generations to come. And the other thing that we want you to do is dream a little bit with us. How many of us get so caught up in life and working in our businesses and our practices that we just don't take the time to step back and dream a little? Where do you want to go? Where do you want to be? How do you want to get there? What do you want your life to look at? Not necessarily in retirement, but now. How do you want to start that shift to get the wealth being built for you outside of the practice? These are great strategies to be able to take to heart and to learn and be a perpetual student of, so that you can import these into your own thoughts and your own practice and your own financial goals. One of the points I had here too is you often hear about when you invest in real estate, that word financial freedom gets thrown around a lot. If you see ads all over the place, talk about that in light of that phrase. What does it look like when you have financial freedom, and how do you get there when you're dealing with real estate?
I think it means different things to different people. I'll start first and foremost off that way. And sometimes there is a shift that has to happen over time too. And, let's talk with anybody who's real estate professional as their means of achieving tax savings. Well, real estate professional isn't just something people wave a magic wand with and all of a sudden they declare themselves a real estate professional. They could, but that's not how the IRS is going to look at it. The IRS is going to look at somebody claiming that designation as being one who puts a significant amount of their own time performing personal services for real estate. So in a way, they are buying themselves a job. That's what it is in the early years. But we do have to look at this in terms of it's a long-term play. So if somebody is a real estate professional and they're able to take those losses, reduce the ordinary income, reduce their tax bill, hopefully they're using something. They're using that tax savings to just keep on buying more and more real estate. And if they do so, well, then they have an option. At some point they can pivot because maybe they no longer need the active side of what's producing the income. Maybe they don't need the W-2. Maybe they don't need the business. They have the real estate being able to cover those expenses. So if that's the case, then they could just 1031 those properties into something that's a little less maintenance. With tax-free wealth, there's an example in the book where they look to do a triple net lease, something where the tenant is responsible for 100% of the maintenance and capital work, and they just get a rent check. They're essentially renting the land, and that's pretty much as passive as it can be in real estate, other than perhaps being a limited partnership and a syndicated real estate investment. So the reason I use that example is because over time that has changed. It's just like if somebody's playing Monopoly and they take all those single-family homes and they convert it into a hotel. Well, this is just the last step in that process. Right. Is having it be just very low maintenance and very low income producing. That could be a real estate professional at that point, but who cares? Right. Because at that point, all of your income may very well be passive. And in the case, I have one particular client where they did not really need tax planning in that respect because they were exiting. A couple was dentists and dental hygienists, and they started acquiring real estate because they knew that would be their path towards financial freedom after they sold their dental practice. So now they're on track to sell the practice this year, and we're looking to we're going to see what else do we need to do. And they threw out a cost segregation study, and we're going to run the numbers. And I'm honestly telling them you may not have to do a cost segregation study. You have enough real estate that the two of you purchased that you may naturally not need any more tax deductions. The income just may naturally be tax-free without having to spend a couple $1,000s to do the study. So I'm not going to rush and tell them to do it. If it's in their best interest, by all means, we'll suggest it to them. Right. But their circumstances did not require much sophistication other than trying to get them set up. So, when we did that strategy, we were focusing on getting them the right structure. We were focusing on them still maximizing the other deductions that they were still entitled to. Both in the dental practices, they were winding it down, and in terms of also trying to ascertain what we could deduct as far as them investing in real estate. Yeah. We're by no means cookie cutter. What every person considers as their financial freedom goal is going to be different, and the way we approach that with every client is going to be unique too. Yeah. I know one of the things that we talk about all the time, it seems like in the business, doing this 35 years, is creating multiple streams of cash flow. And that helps you become financially independent no matter what age you are. Doesn't matter what age you are. But it's just nice to have those. I mean, some of that could be Social Security. Some of that is your investment income. Some of it's real estate income. But as you look, where do you want to be 10 years out? What's your life going to look like if you start today, 5 years out, 10 years out, 15 years out? And you got to take that first step. I always tell people when it regards faith that with every step of faith that you take, the scenery changes, but you got to take that first step for the scenery to change. And once you get to that particular step, now you're looking at something altogether different. And then you'll look back 5-10 years from now and go, wow, I never thought I'd come this far, or I never thought I'd be here quicker than I thought I would be, or whatever that scenario is. But it's just important to take that first step. The other piece here I was just thinking about too is what happens if a doctor owns a building, like they're in their own practice, they own their building, and it's part of their practice. So let's say a doctor has a LLC, an S Corp or whatever, and they are set up that way, but their building is also in the name of their business and their practice is in the same name. Should they split that, or talk to us about that? That's a very good question, and it's one I run into quite often. And it comes back, what is it that people want to be able to do? I think above all, people want to be able to sleep at night. So we want to come in and we want to provide them with solid tax advice that's not only going to save them money, but know that everything we're doing is 100% legal and ethical. Unfortunately, there are people out there that, forget the IRS for a second. There are people out there that are looking to steal that wealth. So I will credit this phrase to another advisor I work with, but he said the phrase they use is protecting assets from creditors, senators, and predators. Senators obviously being in reference to the IRS, but the other idea is if you have these predators that are looking to sneak in and use frivolous lawsuits as the means of trying to get work at people's assets. So now we're not a law firm. We don't do asset protection, but we find that in order to fully do somebody's wealth and tax strategy, we have to take that into account. So what we want to do is we want to work with that attorney while we're doing that process. So it will end up making sense that when you tackle one thing, you're going to tackle both. So it makes sense to do it this way. So the reason I bring that all up is because this is the conundrum we typically have. We have an asset in the form of our real estate that we're using for our office. In some sense, too, that real estate could also be a liability in the sense that just like with any piece of real estate, somebody could be injured on the property. Now let's go to the other side of the equation. We have the practice, and that doesn't necessarily this doesn't even have to be motivated for physicians at this point. This could be any type of business doing anything where you have a physical storefront location. And the idea too is, well, that business could be an asset. The business does have value. It could be sold, and it could be sold for profit, but it's also liability generating. Mm-hmm. You have similar premises claims, but you also have you have employees that can be source of lawsuits. You could have contractors, vendors, or clients that have breach of contract claims. There's no shortage of liability in owning your own business too. So what makes logical sense is to separate those two assets and those two liabilities. Have a separate entity for your practice and your separate entity for the underlying real estate. It turns out too that it's also best for tax purposes too to separate these out. Mm-hmm. So one of the biggest tax mistakes that I see when I work with new clients is people that have real estate in a corporation, specifically when it's investment real estate, it's buy and hold real estate. If somebody's flipping properties, that's one thing that tends to be an active business and is best done in a corporate structure. But anytime people are holding rental real estate, it's not the best for it to be in an S corp or a C corp for that matter. It's best for it to be in a limited liability company, typically with partnership taxation. The business, on the other hand, and again, general rule, I've seen exceptions to this, is often best to be done in a corporate entity, which could very well be a limited liability company taxed as a corporation. So what do? We do both. We may have one company be the active business, and if somebody's a serial entrepreneur and they have multiple businesses, and usually a holding company will make sense. Mm-hmm. Sometimes the answer to C corp or S corp is yes. We may have both. And maybe one line of business is an S corp, one line of business is a C corp. There could be a legitimate reason for that too, and a very tax efficient reason for that as well. On the other side, we may have a holding company for real estate. So that way, if somebody has multiple properties, then one of the nice things about limited liability companies is we can have companies under companies under companies. And we could have all those companies collapse to file one tax return, which is good for the client because it's only one tax return to prepare for mm-hmm. what could be upwards of 50 properties or even more on captured in that return. Mm-hmm. So there's some flexibility there too, but also because we still underneath that parent company we have these other LLCs for. We'll always extreme to each property. We could get the ultimate in protection that way too. Now, of course, it's up to us to set it up. So people may often hesitate to having, if they have 50 properties, they may hesitate to have 50 LLCs. Mm-hmm. Well, the answer to that too is, well, if you lose one property, you're only losing 2% of your portfolio. So maybe you have no problem with having, 5 LLCs and having 10 properties in an LLC, and at most you lose 20% of your portfolio. That's still not insignificant, but it does calm people in terms of the cost.
Right.
So that's where we recommend clients work with a good attorney. I think for the most part, the attorneys will say, well, this is the safest thing. But the attorneys we work with also know what the endpoint is practicality wise too.
Right.
And of course,
Yeah.
we work with attorneys too. They'll try to piecemeal that plan too, and try to make it so that it's suitable for not only the client's risk tolerance but the client's pocketbook too.
Right. And that's all part of protecting what you own, so that you don't get sued for the whole thing. This is the power of a professional team working in conjunction with each other for your benefit all the way through. That's what I was making reference to at the beginning of the podcast even. And just so that we're not making recommendations here. We're just talking about the topics around this and what it looks like. To get any kind of recommendation, you need to speak with us independently, privately for your situation. And I'm sure you know that. But there's one final thought before we close out. Lloyd, tell us about what working with you looks like. What kind of work do you do? And like when you get a new client that you're working with, and then take us through like the first 12 months and what does that look like? What kind of needs do they have and that type of thing?
Sure. So just like I gave reference to with attorneys, sometimes an approach needs to be right fitted for a client, and you need to do the process in piecemeal. So we will give a client the same flexibility when they're interested in working with us. So and by the way, there's two ways of doing that too. The first one is a client could simply come to us and just say right out, I want to do a wealth and tax strategy with you.
Mm-hmm.
Or they may say, let me just get to know Lloyd a little bit better and see if maybe is this person a good fit for me. And by the way, I may not be the best fit for everybody too. I share that my specialty is often with real estate investors, and usually that involves some small business that comes along with it too. Professional services are one of the niches that we like working with. And more importantly, I want to make sure I'm able to help a client.
Yeah.
So I usually will ask to have people send us their tax returns prior to that first call. And I'm going to want to look at that and see if there's opportunities or maybe even there's mistakes. So sure enough, we had a client, I just interviewed them this morning, and I basically pointed out there was an error on the person's taxes. It probably cost them about $1,000. Now $1,000 might be chump change to some people, but the idea was, well, there was still a mistake there. So without even needing to do anything more for them, we gave them something that they go back to their prior account with and say, hey, what happened here? Can this be fixed? And the mistake was purely, it was computational. That something as simple amended return would clear up. Now, there could be things that are mistakes too. I mentioned, for example, having real estate in an S corporation. Well, that's not just a simple paperwork mistake. That's something where we need to kind of have a plan to get the real estate out of the company somehow. And there's a couple ways I've done that with clients. Sometimes we just say to the client, you know what, especially if the market's depressed, you're able to get it out at a low rate, you're going to pay taxes at a lower rate too, because it's based on the fair market value of the building. And then we start from there. Sometimes there's other ways that we could drop the property down into another LLC and then dilute that ownership interest. There's right and wrong ways to do so.
Mm-hmm.
Sometimes a client just wants us to know that we're in the corner, and they may start off with, similar to what you said. We may very well be that reactive CPA for them for the time being, but they might say, well, I'm going to be able to sleep at night. Mm-hmm. I may not want this person to do a strategy for me yet. It's not within my budget, but at least they could say, hey, listen, I did your return. I noticed that we probably could do this better. Would you be interested in having a conversation? And 9 times out of 10, they're going to answer that question, yes, if we see something. And that's the idea. We're still going to see it. We may not have been able to do anything about it in the past, but we can look to adjust it going forward. So we're still in their corner, even if that's what they want us to do. The clients that get the most value from us work with us to do that wealth and tax strategy. We develop that comprehensive plan to reduce their taxes in their business, in their investments, and also give them the education in order for them to identify some of these opportunities going forward too. Now, it's not that we tell them about an opportunity and then expect them to implement it on their own. Absolutely not. Mm-hmm. But sometimes we want them to know, hey, if this happens down the road, we want to know about it because we have an opportunity to save you taxes on it.
That's it.
So it's about us having that happen in tandem, because the reality is, yes, there's going to be some people that we meet with as often as monthly, but until between that next meeting, we're going to rely on them and their communication to tell us some of the things that they need to be on the lookout for. And of course, we couple that, we say that too, because the clients who meet with us the most are going to get the most value from our services.
Yeah.
So we typically set that up as monthly consulting arrangements, which covers those meetings and it covers the tax returns too. And then we're looking at their books proactively. We're looking to see, okay, well, based off of what you're doing so far, and again, this differs from client to client. If their strategy is going to be minimize their taxes by buying more real estate, well, that's what we're going to throw out to them. If their strategy may just involve otherwise accelerating expenses in their business, they may just be looking at prepaying next year's expenses, and perhaps reversing that in a year where perhaps business isn't as well as it could be. But the idea is if we know that this is what we need to fine tune in a client's strategy, this is what the single variable we're going to be looking at the most.
There is nothing like a proactive financial team of professionals who have your best interest at heart and hold themselves accountable every day to make sure that they know what you need to see your goals through, to partner with you, taking a vested interest in your success. And that's exactly what we bring to the table. And I appreciate you saying that, because what you said just summarized that whole thing in a little bit more detail. That's awesome. As we close this out, I just wanted to share my screen here for a second. And if you don't have the video version of this podcast, you'll have to hear it through. I've got up on the screen 3 vital signs every doctor needs for healthy wealth. We're building a webinar right now with 3 vital signs that you're going to need to get to or maintain healthy wealth. You won't want to miss this. I'll give you the first one right now. It's all about customization. These are going to be 3 separate webinars linked together. And if you want to be part of this webinar experience, you can always email me at kdsullivan@lpl.com, kdsullivan@lpl.com. And once we get these finished, we're working on them right now, we will let you know so that you can take advantage of them. Don't ever think that customization is not a big deal. It's a huge deal. You don't want to be thrown in with the masses with your investments. You don't want to have something that's cookie cutter, that's prearranged, that say, hey, if you're 30 to 50, this is what most people do in that age bracket. So here you go. And sometimes you could be over diversified with your investment portfolio for all the wrong reasons. So we talk about that. We talk about how you can get customized and have your own signature solution for what you need. So you won't want to miss these particular webinars that are coming out. So I just wanted to throw that out there for you as we close out this podcast. I want to thank Lloyd very much for all of your insights today on all the topics that we had today. So thank you, Lloyd.
No problem, Kevin.
Any closing thoughts, remarks, Lloyd, that you would like to make before we go?
I would like to say one more thing. I think when I was on your podcast last time, I talked about the emphasis on record keeping. And sometimes what clients are hurting themselves the most is if they don't have good record keeping.
Yes.
I want to say the next thing I think, when somebody's improved the record keeping, I think the next thing people should work on is education. And I think, certainly physicians will be no stranger to the fact that they need to, stay on top of continuing education requirements. And the reality is, CPAs, for us, it's no different. But do people consider that in terms of their investments too? They think about what they should be keeping up on in terms of their area of investment. And let's just say that is real estate. Are you keeping up with, ways to go about what we might call creative real estate? I think everybody would be living under a rock if they didn't know that interest rates have increased dramatically in the past, year and a half or so. And that's changed the way that people are looking to acquire real estate, for example. Right. And I think in many respects too, people that are going to focus on their education, whether it's continuing education or if they're just looking to get started in real estate, the school of hard knocks, trying to do it on their own without that foundation, is just going to be putting them into a world of financial pain. Right. So I definitely would encourage people that if they're looking to go down taking that self-managed approach with their investments, that they learn the right way and work with somebody they trust to give them that education. We're happy to come in and handle the tax side of that education, and be part of their team in that respect too. And in many places, a business coach may be a great investment for the business, and certainly would be deductible too. If somebody's looking to expand their practice and they hire somebody that's going to help consult them on that, well, that's just going to be just as valuable too. Right.
Great points. If you're going to build your future, you want to give yourself the best shot that you can to get it done. And that comes with sound education along the way, just so that you know that you don't have to make the mistakes that other people have made before you. And it just makes all the sense in the world. So thank you so much today, Lloyd. I appreciate it. Doctors, thank you for listening, for tuning in. Please share this podcast with your colleagues, your friends, and associates. It's got a lot of good wealth information here. We're going to shoot another podcast you won't want to miss, and I'm going to keep that one a secret. It's happening this Thursday, but we'll see you again soon on the Physician Wealth Med podcast. Thank you. That's our podcast for today. And remember, if you're not working on your personal wealth, who is? Please share this podcast with your friends and colleagues, and make sure you subscribe, like, and share. Any questions about what you heard today, please send an email to kdsullivan@lpl.com. Physician Wealth Meds, wealth medicine for doctors. Lloyd Ippolito is not affiliated with or endorsed by LPL Financial or Physician Wealth Meds. Securities and advisory services are offered through LPL Financial, a registered investment advisor, member FINRA and SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.